Hi, 514th. Welcome to the Wellness 52 presentation for the July 2020 UTA, presented by the 514th Airman and Family Readiness Center. Wellness 52 is a program we created earlier this year in an effort to engage and inspire our airmen here at the 514th to live a healthy lifestyle in and out of uniform. We've covered topics like spiritual health, mental well-being, employment tools and strategies, and this month, we're going to be focusing on financial literacy. It's great to have you here. We wanted to make these classes more interactive, but given the situation with COVID-19, it's been difficult. In spite of that, we're doing recorded versions, and hopefully once things get back up and running again, we can do live seminars in the classroom here on base. Here's the agenda. First, we're going to play a fun game called Spent, and I'll explain that in a moment. Then we're going to get into some financial topics like health insurance, real estate mortgages, credit cards and debit cards, credit score, debt, budgeting, investments, and then finally, we're going to leave you with some tools and resources that you can take home with you. Okay, now what I'd like you to do is go to this website here. It's www.playspent.org. And I'd like you to play this game before watching the rest of the presentation. The game was created by an ad agency called McKinney, and essentially it was created to raise awareness about poverty and homelessness. It's a really fun game that kind of challenges you to think. You're giving $1,000 and your goal is to survive an entire month based on that money and then money from working. The game's going to prompt you with questions, difficult questions, questions that question your ethics, your morals, your values, things of that nature. And it's going to be difficult, but you have to make the hard decisions because that's what life is all about, making difficult financial decisions, especially when you have a limited budget. And so what I'd like you to do is play the game and see how far you get. If we're doing this live in the classroom, the goal was to kind of see who could win, but it's more difficult now, and I had prizes and things like that. We'll do that down the road, but for now, I just want you to play the game and see how far you can make it. See how far you can make it. Can you make it the whole month? Do you last 5 days, 10 days? When does your money run out? So pause the presentation, go to the website, play the game, and when you're done with the game, come back. So I'm going to assume you played the game and hopefully you all made it through the month without running out of money. And if not, well, that's what this presentation is for. So hopefully some of this information will be useful and then you can use it. And what I'd like you to do is play the game after and see how far you can make it and see if you've improved. So first topic is health insurance. That was probably one of the first prompts you received. I'm going to go through some basic terminology because it gets confusing sometimes. So premium. Premium is simply the amount of money you pay each month to have health insurance. So it's a monthly amount that you have to pay each month for your policy. Now, copayment, that's the amount you pay at the doctor's office. So typically you'll have a $25 copayment with each visit. That's what that fee is. Deductible, that's the amount you pay before your insurance kicks in. Now there's different plans. There's high deductible plans, low deductible plans. We'll get into that in a second. But for example, if you have a $2,000 deductible on your insurance policy, that means that you have to pay out of pocket until you hit that $2,000. Once you've spent $2,000, then your insurance kicks in and they offset a percent of your medical costs. Coinsurance, well, essentially that's what that is. It's a percentage of cost you pay after you've met your deductible. High deductible versus low deductible plans. High deductible plan is great if you don't see the doctor very often, if you don't need a lot of medical care or attention, because your monthly payments or premiums will be very low. But if you do have to see a doctor, it's going to cost you a lot of money until you hit that deductible. For example, like I said before, if you have a $2,000 deductible, you're going to pay 100% of the cost until you hit that cap. and then your insurance will kick in. So it's great if you're in good health and you don't go to the doctor very often. On the other hand, a low deductible plan is great for people who have medical issues, who need medical care very often. You're going to have higher monthly premiums, but then when you go see a doctor, it'll cost you a lot less. Now, there's a lot of different factors that affect your premiums and the amount you're going to pay. Things like age, of course. If you're young and healthy, then you're going to be paying a lot less than someone who's elderly. Location, if you live in a city or an urban environment, generally you're going to pay more than someone who lives out in the country somewhere. Tobacco use, smoking use versus non-smokers, it's huge actually. The surcharge is sometimes 50% greater. So you'll be paying, a non-smoker will be paying $300 versus a smoker will be paying $450. So that's a lot of extra money for tobacco use. Family size, bigger family, it's going to cost more, and that type of plan. Now there's several different plan types. HMOs, those are the lowest cost plans, but they're not very flexible. You're very restricted in terms of which doctors you can see. You might have to travel very far just to see a doctor within the network. If you go out of network, you're not going to be covered. POS, it's slightly more expensive, but you can see doctors out of network. Generally, if you have a referral from your primary care practitioner. EPO, it's only in network, but there's a more variety. You have more doctors to choose from. PPO, that's generally the best, but it is the most expensive. You can see specialists and doctors out of network with no referral. Now, the Affordable Care Act created a health insurance marketplace several years ago, and that the idea was to create health insurance more accessible and more affordable for people. And it's similar to the high deductible, low deductible information that I spoke about earlier. So the bronze, you consider that a very high deductible plan. Basically, you have the lowest premiums, but the higher out-of-pocket costs. Whereas the gold and platinum plans, you have higher premiums and lower out-of-pocket costs. Now, there's two savings accounts that are helpful to pay medical expenses. The first is the flexible spending arrangement. That was created in the 1970s. It's been around for a while. It has tax advantages. Money you put into that is pre-tax, is used with pre-tax dollars, and you use that money only to pay for medical expenses. The problem with the FSA is that any money left over at the end of the year is forfeited. So if you have a balance of $200 or $300 at the end of the year in that account, it just goes away, which kind of stinks, but that's how it is. As far as the health savings account, that's the alternate. That's generally available for most high deductible plans. It's very, very beneficial because you can put money pre-tax again, and the money that's withdrawn does not get taxed. And the good thing about the health savings account is that money grows and it's not forfeited at the end of the year. You can actually use it for retirement. So it's really very beneficial. And that's more recent. It's only been around since early 2000s. Real estate. A common question people have is should I buy or rent? Should I buy a home or should I rent? Well, it really depends on your personal situation. Do you think you'll have stable roots for quite some time, or do you want something more flexible? Generally, it's advised to buy if you plan on living somewhere for at least 3 years, preferably 5 or more, because you're going to absorb a lot of the upfront costs like closing costs, maintenance, repairs, and things like that in the early years. But of course, there's a lot of things that come into factor when you're thinking about buying a home, like your down payment, like I said, the closing and renovations, ongoing costs, homeowners fees, if you live in a condo, taxes, of course, property taxes, as you know, in this area are through the roof. But of course, you can also use the property tax deduction, which is beneficial. Now, as far as renting, always think about, how long is the rental term? Where's the lease contract? Is it a 1 year, 2 year, 3 year contract? Can they increase your rent after a year? So it's important to know that information. Of course, the real estate market is critical. You need to analyze the current market conditions. What are interest rates like? Are interest rates low? Are they high? Is it a good time to buy if interest rates are low? Generally, yes. Right now, given the economy, the situation with the virus, interest rates have come down a lot. So maybe a beneficial time to purchase a home. And of course, you want to analyze the real estate market in general. What's the appreciation potential and things like that. The good thing, and we'll get into it in a second, is that being in the military, we qualify, most of us qualify, and I'll tell you in a second about kind of the restrictions for a VA loan, which is huge benefit because you don't have to, it does not require a down payment. I'll get into that in a little bit. Some of the factors to consider when renting, of course, there's a lot of factors, and think about like where you're going to park your car. Is there a parking fee? Utilities included? Hot water, gas, electric, laundry. Is there a laundromat nearby? Amenities, things like that. What can you afford? General rule of thumb is that you should spend no more than 30% of your gross income if renting and 28% of your gross income if buying. I'll give you a good example. Say your salary is $100,000. Well, 30%, say you want to rent something. 30% is 30,000, divide that by 12 months. That means that you should not pay more than $2,500 a month for a rental. Say you wanted to buy something instead. Well, 20% of 100,000 is 28,000, and then divide that by the amount of months in a year, and that's roughly a little bit more than $2,300 per month. So you don't want to spend more than $2,300 a month if you're buying. That leaves some wiggle room for repairs and expenses and things like that. Taxes, of course, too. When looking for a property to either rent or buy, it's important to look at the cost of commuting. Where do you work? What is the cost of commuting to your workplace? Most people need to do a cost-benefit analysis and kind of determine, take into factor the rent, the miles from work and things like that. And I'll give you a good example or a good fact. Each mile away from work costs you essentially $170 in car expenses annually. Say you live 20 miles away from work. 20 times 170, that's $3,400 a year in car expenses. You're probably saying, well, gas isn't that expensive. But that includes things like the car's depreciation value, oil changes, regular maintenance and repairs. So all that is taken into consideration. That's a lot of money. Over a course of a 30-year career, that's $350,000. So think about that when you're looking for a place to live. And always consider alternatives like public transportation, biking. I work in New York City and I use City Bike to get around instead of the subway. And that saves me more than $5 a day. And of course, there's other options as well. Mortgages. Two types of mortgages, fixed rate and adjustable rate mortgages. Fixed rate, the interest rate does not change. You're gonna know what you're getting yourself into. It offers predictability and stability. It is generally, the interest rate is usually higher because you have that stability and predictability. You can always refinance, but of course, it's not going to be free. It costs you additional fees up front. The other option is the adjustable rate mortgage. Adjustable rate mortgage, the interest rate can go up or down over the life cycle of the loan. Usually you'll start with a lower interest rate, but don't be fooled. That interest rate can go up, and it can go up fast, and it can get you into a lot of hot water. That's the whole reason why the housing market crashed in 2006, because people were paying one rate and those adjustable rate mortgages increased, and they couldn't meet their mortgage payments because the rate went up and the amount they were paying per month basically exceeded their budget. The good thing about that is that you don't need to refinance if you want to take advantage of falling rates. But like I said, it's very unpredictable. It's complicated and also difficult to understand. Usually the terms will be 5-1, for example, and that means that the rate will be fixed for 5 years, and then after that, the rate adjusts. The rate adjusts based on a margin rate, which stays constant, and another rate, which is usually the LIBOR rate, which is adjusted daily. So you take that margin rate of 3% and you add it to the LIBOR rate, and that's the interest rate you'll be paying. And I'll get into that on the next page. I think there's an example. 15-year versus 30-year mortgages. Most people opt for the 30-year mortgage. You're going to be paying a higher interest rate though, and it's going to take a lot longer to pay off. But however, you do have lower monthly rates. You build up equity more slowly. You're going to pay a lot more interest over the life of the loan compared to a 15-year loan where you're going to be paying probably a lower interest rate, but equity builds up very quickly. Of course, you're going to be paying higher monthly rates, but less interest over the entire life of the loan. Okay, here's that example I was talking about. For example, if you have a $300,000 mortgage on a home, and you're going for an adjustable rate mortgage, it's a 5-1. So that means the initial rate is 3%, and that stays fixed for 5 years, but then after that it adjusts. So your initial monthly payment is $1,265. However, let's pretend that interest rates go up. The maximum monthly payment that you could possibly or potentially be paying is $2,200 a month. And so that's a huge difference. That's $1,000 more you're paying per month. So think about that before you consider entering into an adjustable rate mortgage. The one good thing about it is that there's usually a cap and a floor. So you'll know the maximum potential interest rate you're paying. In this example is 8%. It's that 3% margin rate plus the 5% LIBOR rate or index rate. Now we have, like I said, the 30-year versus the 15-year mortgage. And this is just another good example where you'll see here that if you go for the 30-year mortgage, the interest rate's higher than the 15-year mortgage, but, and you're also going to be building equity more slowly than the 15-year mortgage. And you're going to be paying a lot more interest for a 30-year mortgage than for a 15-year mortgage. The total interest paid on a 30-year mortgage is $108,000 versus only $40,000 in interest paid on a 15-year mortgage. And that, I believe, is on a roughly $200,000 mortgage. Getting into the VA loan and the great benefit that we have in the military is the VA loan. It's essentially just a mortgage loan issued by private lenders and backed by the U.S. Department of Veterans Affairs. Who qualifies? Any active duty service member who was honorably discharged, any active duty service member or an honorably discharged service member with 90 days of active service during wartime or 181 days during peacetime. Reserve and National Guard members are eligible if they have served more than 6 years, and the spouse of a service member who died in the line of duty. What are the benefits? As I said earlier, no down payment. That's a huge benefit because typically a mortgage will require you to put 20% down. If you don't put 20% down, you're going to be charged private mortgage insurance, which is a couple $100 per month, which is a lot of money. With the VA loan, you put down 5% and you don't have to worry about PMI. Of course, it makes sense to put down as much as you can because you'll be paying less interest, but again, it depends on your personal situation. The other good thing about the VA loan, there's generally less stringent as far as credit score. However, you may not get the best rate. It's also a lifetime benefit, so you'll have it for life. Some of the disadvantages going to that is the funding fee. It's a one-time fee, 2 to 3% usually. And like I said, it's not always the best interest rate. It must be your primary residence. Now, this is very critical. You have to live in it for 1 year. You can't just buy a property and say, oh, I want to Airbnb it or I want to flip it. You must live there. It must be your primary residence for 1 year. After that, you're free to move on and use the loan again, but you must live there for 1 year. And vacant land and co-ops do not qualify. These are just some fact sheets about VA loans, the process, and things like that. You can learn more on the website, which I'll list later in the presentation. Credit cards and debit cards. Credit cards, I'm sure most of you are familiar with these, but I'll just briefly run through the benefits of them. Credit cards, of course, you're borrowing money from a bank or a card issuer. Debit cards, you're using your own cash. It's like digital currency. Credit cards, the advantage is better protection, warranties, fraud. If you receive poor service or a damaged product, the credit card company always has your back. The rental car coverage. So a lot of people use credit cards for rental cars. Say you're on vacation, you're at the rental car counter. They're giving you the hard sell on why you should, sign for the collateral damage waiver and get their insurance with the rental agreement. But usually it's not necessary at all. Usually you're covered by your own private auto insurance. And then on top of that, your credit card usually has your back as well. So make sure you use the credit card and understand the contract and what the credit card covers you for, of course, before agreeing on the rental car. Points and rewards, these are great credit cards. So many bonuses out there, travel perks. It's good to have a card for groceries so that you get grocery perks. You can have a separate card for gas, gasoline perks, and things like that. It makes sense to use those rewards. Disadvantages. Late fees, of course, interest, annual fees. Read those contracts. Some cards charge you a couple $100 in annual fees. Of course, there's so many cards out there where you're not charged an annual fee. Introductory offers. A lot of times cards will give you a 0% APR rate for 12 months. But then after that, it skyrockets to like 20% per month. So make sure you read these contracts. Be careful what you're getting yourself into. And of course, avoid carrying a balance. So it's easy to rack up debt. Low credit score affects your ability to borrow for a mortgage, for an auto loan, and things like that. Debit cards, money's withdrawn directly from your bank account. They're much safer. They're easier to obtain. It's very good as far as not accumulating debt. There's no late fees, interest charges, or annual fees. However, if you do withdraw more than it's in your account, then you will be charged an overdraft fee. So be careful. You need to monitor how much is in your account, what your balance is. There's less protection with debit cards than credit cards. It's much more difficult to fight poor service, fraud, warranties, and damaged products and things like that. Also, they're not always accepted everywhere. And there's really very minimum rewards that come with debit cards. This shows you some more information. You can read that over later if you'd like. It's interesting to know that there's basically two parties involved in a credit transaction. There's the credit card network. Essentially, that's Visa, MasterCard, American Express. They process the transaction. That's all they do. Then you have the card issuer. The card issuer is the bank. That's the entity that's going to give you that capital. It's going to give you the loan to make that purchase. So there's two players involved. The bank is usually Chase, Citigroup, Wells Fargo, things like that, companies like that. Credit score and debt. Credit score is a very complicated calculation of your credit worthiness. It generally ranges from 300 to 850. A good score is 680 and up. It's based on credit history. How much credit have you built over your lifetime? What's your payment history like? How many debts do you have outstanding? What are your balances? How many credit cards do you have? Types of loans you have? And all this comes into play and you come up with a credit score. There's a way to look at your credit score, which I have a link later in the presentation, which certainly it's free, and I recommend you check out your credit score and your credit history. So lenders use it to kind of evaluate the probability or the likelihood that you'll satisfy your debts. And they're going to use that to determine the interest rate you receive on loans and things like that. And of course, your ability to even qualify. So how can you improve your credit score? Pay your bills on time, pay the full balance off every month. This is interesting. Do not close any cards you do not currently use. So if you have a credit card that you've had for a while, but you don't use it anymore, it's actually better not to close that card, because it has a negative impact on your credit if you close credit cards. So keep it open even though you don't use it. But just make sure you're not being charged an annual fee. Getting out of debt. As I said, always try to pay more than the minimum payment. Try to pay that full balance off each month. If you want to make a purchase, make sure you can afford it today. It's actually possible to ask for a lower interest rate, believe it or not. Call up the card company and ask them for a lower interest rate. It doesn't hurt to ask. And there's two methods that are very popular with kind of getting yourself out of debt. The first is the snowball method, which essentially is you pay all of your small debts first. It kind of builds momentum. Pay off in full all of your small debts. It kind of builds momentum. The other method is the avalanche method, where basically what you do is you make the minimum payments on all of your debts, and then use the remaining money to pay off the debt with the highest interest rate. Of course, you can try consolidating debt through a home equity loan if you have a mortgage. The other option is to transfer a balance to a new credit card with a low or 0% APR. But be careful with that, because make sure you understand when that 0% APR is going away. I have actually an example here. Say you have a $5,000 debt with a 15% interest rate. If you make the $100 minimum payment per month, it's going to take you 7.5 years to pay off that debt, and you're going to have to pay almost $3,000 in interest. So that $5,000 debt is really an $8,000 debt if you look at it like that. Now, say instead of having this debt, you invested that $5,000. Well, in the same amount of time, in 7.5 years, that money would have doubled, and you would have $10,000 today. These are just a few more graphics that kind of show you credit scores and the factors that make up your credit score and things like that. Interesting, the chart on the right is what the real cost is of bad debt. So if you have a poor credit score, your interest rate is going to be much higher than someone who has a very high credit score. Roughly 6% versus someone who has a good credit score, it's only 4.5%. So as you see here, the differential is over $100 per month. And this is for a $200,000 home loan with a 30-year mortgage. So think about how much money that is over the entire 30 years. Budgeting. Budgeting is a simple process of determining how much money you have coming in and how much going out. It's keeping track of your income and your expenses, establishing good spending habits, and of course, saving money to achieve your financial goals, whether it's a short-term goal, a medium long-term goal, or a long-term goal. Going on vacation this year, buying a house in 3 years. Write down your goals and make them smart. How do you do it? Simply add your income and your expenses. It's good to do it on a weekly, monthly, and yearly basis. All of your income, your civilian, your military, any other money you have coming in, and then your expenses. You have different expenses each month. You have fixed expenses like your rent, that doesn't change, and you have variable expenses like probably groceries, gas, entertainment, things like that. It's good to take an average of those and kind of come up with a monthly budget plan, weekly budget plan, and a yearly budget plan. And then assess how you're going to meet your financial goals. It's also good to create an emergency fund, a 3 to 6 month stash of money in case an emergency comes up, in case you lose your job, in case you encounter a huge family medical expense. Make sure you have some money set aside. There's a lot of free tools online with budget for you to kind of create a budget, kind of import automatically your savings accounts, your checking account, your credit card accounts, and it gives you a good snapshot on your situation. Mint is a great one. You need a budget, Pocket Guard. These are all really helpful tools and resources. So check them out. Oh, before we move on, I had an example written down here on what saving can do for you. Say every day you get a $2 coffee for breakfast. Well, that's $62 a month and roughly $700 per year. And say you also get an $8, you go out to lunch every day and spend $8 on lunch. Well, that's roughly $250 a month and $3,000 a year. So if you take that money and instead of spending it on coffee and lunch, you invested it. Well, if you're only 25 today and say you retire at 67 and you earn 8% per year on that investment, you're going to have over $1 million. So that's really amazing to look at it like that. The rule of 72 is a good rule of thumb. It basically says how long it will take for you to double your money. Essentially what you do is you take 72 and divide it by your interest rate that you're receiving on your investments. So for example, if you're getting 10% a year on your investment, it'll take 7 years for that money to double. So divide it by 72 by your rate of return. Just another graphic here. Speaking of investments, here's just a brief rundown on some major asset classes. Of course, there's a lot out there. Stocks, that represents partial ownership in a company. You receive dividends and voting rights. Stocks are very volatile. They move up and down. So they are more risky, but you have a high potential for return and of course a high potential for loss. Bonds or fixed income instruments, they are much less risky. Bond is essentially a loan. You're providing money. You're loaning money to a company or a state government or the federal government. The thing about bonds, much less risky. You receive coupon payments and then principal at maturity. They're less volatile, but you have, since they're less volatile and less risky, you have a much lower return. However, you have limited downside, so your money is more protected. Mutual funds, on the other hand, those are assets that are professionally managed by money managers. It's a pool of stocks, so you're contributing your money into a pool of securities that a professional money manager kind of devises on a based on different sectors. So you can have mutual funds on small cap stocks, large cap stocks, foreign or international securities, and things like that. So you have some flexibility on where you want to put your money. They're much more diversified because they include a huge pool of stocks as opposed to just one or two. And however, mutual funds charge annual fees called expense ratios. So it's important to look at how much the mutual fund is charging you to invest your money. Exchange traded funds, those are nice because they're kind of a hybrid between a stock and a mutual fund. They are more liquid. They trade on an exchange like stocks, lower fees, but you do have to pay commissions. Asset allocation is just a term that means the ratio of stocks, bonds, and other investment vehicles that you have. The factors that influence your asset allocation, of course, your time horizon. So if you're young, you can have a more aggressive portfolio, more in equities and stocks as opposed to fixed income, which are more conservative and less likely to go up or down. Someone who's more towards the retirement age will have more of their money invested in fixed income than stocks. And of course, your life goals and things like that make a big, are very important as well. Maybe you're young, but you're saving for something. You might want to risk that money into a very volatile asset. Rise of the machines. This is basically a new wave of innovation in the investment industry. Algorithmic data and AI-driven investments take your money and invest it as they see fit. They automatically invest and rebalance based on what the market's doing and based on your life situation and based on inputs you provide. And I'll get into that. I think I have a few resources later on in the next slide maybe that kind of show you some websites you can check out and perhaps use. Oh, a good rule of thumb is to take your age and subtract it from 100, and that's the amount of money you should have invested in stocks. So if you're 30 years old, 100 minus 30 is 70. You should probably have 70% of your money invested in stocks. If you're 70 years old, 100 minus 70, you should probably have 30% of your money invested in stocks or risky instruments. Just two more graphics here. Okay, so here are some very helpful tools and resources. Earlier in the presentation, we talked about whether it's a good idea to rent or buy a home. This website here on NerdWallet is great. You input your personal data and financial information, and it will tell you whether it's a good idea to buy or rent. Health insurance we discussed. Free credit report, it's great, and I recommend you get yours today. VA loans, very helpful information on the website, the official website here. Budgeting and resources, as I discussed earlier. Investment education, if you're more interested in learning about investments, Investopedia is a great resource. What is your financial well-being? Kind of tells you your financial health based on your income and debt. Personal finance calculators, bankrate.com has a lot of great calculators out there. Stock market game, before you want to put your money to work in the real world, stockmarketgame.org is a great resource to kind of test out and play with some money and see how you do before you put your real money to work. Financial Literacy and Education Commission, mymoney.gov. Of course, there's a lot of free finance classes out there on massive open online courses. And then the robo-advisors that I was just talking about. Check out Wealthfront and Betterment. Those are two of the robo-advisors. They've been around for a while and they're kind of well regarded. Well, that's the end of the presentation. Hopefully some of this information was useful. Feel free to share it with your wingmen and with your family and friends as well. Any questions about the topics, please reach out to me. That's my personal email and cell phone. The slides that you see here are available on Dropbox at that link. And if you haven't joined the Wellness 52 group me, please join and get connected with us, and we'll send you information and we'll let you know what our upcoming programs are. And of course, visit us at the Airman Family Readiness Center. That's building 3435. Left side of the road, right before the traffic circle when you're headed towards the BX. Well, thanks everyone for joining us today. Really hope everyone, you and your families are staying healthy and safe, and hopefully, before we go, I'd also like you to play the game Spent one more time, see how you do this time, rethink some of those tough questions and see how you do. And look forward to seeing you again soon.